Now, in today's day and age, as we record this on December 23rd, 2020, markets are a bit frothy, especially when it comes to growth stocks. And one could make the point perhaps that this is not the time to be finding any of these potential compounders. In fact, there probably aren't even any that are available publicly anyway. But you have a different approach here, somewhat different, in that you find these compounders in unusual places. And we're talking literally unusual places in that they are traded on other exchanges outside of the US. And what we're going to be calling wrong exchanges, meaning not the NASDAQ, not the NYSE, not the Amex or anything like that. So tell me about that.
So let's start with a couple of premises there. First of all, what do I mean by the wrong exchange? By the wrong exchange, I mean an exchange where a natural set of buyers or potential investors who are very likely to be interested in a particular security driven by the nature of the business and the customer base and the geographic markets are generally not looking at the opportunities. So for example, if a company does business in the US, its headquarters are in the US, its customer base in the US, it would be very logical to expect that its investors would also be likely in the US. They would understand the market, they would understand the product, they would understand customer needs, they can do their diligence, they can travel to see the company, obviously before COVID. Now imagine that company with that fact pattern, where 80% of revenue comes from the United States, actually trading on London AIM.
Okay.
UK investors who are more likely to be familiar with the stock because this is where the company trades, may not necessarily be very well versed in the intricacies of the US end market for that company's product or services. At the same time, US investors may not even know about the company's existence because it's listed on what you and I agreed to call the wrong exchange. Let me give you a particular example from the investment history of mine and Caro-Kann Capital. About 4 years ago, slightly more, I found a stock that of a company called GAN, G-A-N. And for disclaimer purposes, Caro-Kann Capital and its affiliates are still long shares of GAN. This is not investment advice. I'm using this as purely for illustrative purposes and for educational purposes only. So we found a company called GAN. GAN was trading on the AIM exchange in London, which is junior exchange of London Stock Exchange. But the CEO, as well as key management team members, were based in the US. And about 80% of its revenue was coming from the US, from the US clients. The company was making a software, it was a software as a service company for casinos to bring casinos online and develop online presence. Obviously, looking back, it has become a big trend, and the GAN benefited not only from its execution, but also from positive developments in the market, especially during 2020. But most American investors were not looking at the stock. Why? Because it's listed on the wrong, again, in quotes, stock exchange. And this leads us to a potential catalyst down the road. In case of GAN, the company actually relisted its shares from AIM, where it doesn't trade anymore, to NASDAQ earlier this year. And going into that uplisting, this was the moment when the stock started getting discovered by American-focused investors who, of course, understand the trends such as iGaming, online sports betting, legalization wave going through the United States of America. They appreciate those trends a lot more than UK investors. So that's an example. And the stock has gone up literally 11x during our holding period.